Let's be honest, 2025 has been a year dominated by large cap tech, AI-driven hype, and plenty of FOMO. As the market soars back to peak levels once again, all of a sudden everyone feels like a genius again. But here's the problem. It is far tougher to find great opportunities when we're at all-time highs in terms of price and, more importantly, valuation. So if you're looking around right now thinking, where do I find the value? You're not alone. Today, we're going to break down 3 companies that have taken a hit as of late. Stocks that may not be the favorite right now based on the voting machine that is the stock market, but they could have the potential to outperform the market in coming years. Now listen, when we say undervalued, we're not talking about hype headlines or stocks that just pulled back in price by 10 or 20%, and all of a sudden people think they're cheap. Yes, when a stock goes down, it is cheaper, but it doesn't mean it's cheap. I'm going to let you in on a secret that everyone overlooks. Just the fact that you're watching this video puts you ahead of so many other people. Markets overreact in both directions, up and down. Sometimes investors push good companies way too high. Other times, they punish strong businesses just because of a bad headline or short-term fear or because they're no longer the cool company to own. That's exactly where value investors like myself and others step in. When the pendulum swings, it creates opportunity. What we're going to do today is analyze 3 well-known companies, Crocs, JD.com, and Oracle, and then we're going to run them through our process. We're going to look at their story. We're going to look at their financials, and most importantly, we're going to compare price to value because that is the foundation of everything we do here on Everything Money. It's not just about finding a great story and a great company. It's about finding great companies that make sense. It's about finding great companies at great prices. So let's go dive in. All right. Stock number 1 is probably going to make you guys chuckle just a bit. It's Crocs. Yes, those really awful but very practical shoes that a lot of men love to wear. People love to joke about them, but guess what? While people may be laughing, Crocs has quietly become one of the most profitable footwear brands in the world, boasting an industry-leading 59% gross margin. What does that mean? Every Croc they sell, almost 60% of it is profit for them. Yes, they have overhead and all that stuff, but every individual unit is 60% of profit. Now the company continues to face significant backlash following their acquisition of Hey Dude, which was intended to open up a new customer base and diversify their product offering. Unfortunately, in the most recent quarter, Hey Dude's brand revenue declined 21%, massively underperforming the primary Crocs brand, which showed only slight declines. While this is a real negative, the company continues to use their cash flow to buy back shares and pay down their debt. Now remember, guys, when it comes to buying back shares, not all share repurchases are good. If you're buying at really high valuations, you're destroying shareholder value. If you're buying back inexpensive and low value shares, you are doing a great job. Now, there's something important here that I want you to remember as we analyze this company, even a declining business. Now, there's something really important I want you to remember as we analyze this company. Even a declining business can be a good investment if you pay the right price. Let me go to an extreme here and just talk about it. If you look right here, Crocs right now is generating last year's $700 million in free cash flow. Okay, so let's say Crocs was generating 700 and then 600 and then 500 and then 300 and then let's say 0, just to make it simple, over the next 5 years. So in year 5, they're going to go to 0. And let's assume there's no debt. I'm doing it for the purpose of explaining this idea. So for the next 4 years, they're going to generate 1.3, 1.8, $2.1 billion. And the business is worth 0 at the end. Let's say there's no inventory. Everything is 0. Guys, what would you pay to make $2.1 billion for the next 4 years? Would you pay $1? Of course you would. Would you pay $1 trillion? Of course not. Somewhere in the middle, this stops becoming a good investment and starts becoming a bad one and vice versa. That's the ideas I want you guys thinking about. Yes, so a story sucks. And if it's declining, and let's say God came down and said, Crocs is going to go to 0 in the next 10 years, there's still a good price to pay. I'm not telling you that's the right investment for you, but I want you to change your thinking from declining and going to zero means bad investment. It's all based on the price you pay. So let's go dive into Crocs and figure out what is the price we'd pay today to own this company. Now remember, we're going to use our stock analyzer tool to make assumptions about the future, and it'll tell us which price to pay. So first off, in our community, the stock is currently at $89 a share. Our community members have this as an average intrinsic value of $136 and an average rating over the last 6 months of a buy. It's a $4.8 billion market cap, generating $700 million in free cash flow. Why is this interesting? Well, if you look right here, their net income was only $182 million last year. So people are focused on 26 times earnings, but they're only selling for 7 times free cash flow. 7 times free cash flow. Now, I don't know what the future of Crocs is, but at this metric right here, it deserves some sort of investigation. Now, I will say this. The market cap is $4.8 billion. Call it 5. That means if you bought every share outstanding, that's the price you would pay to own the company. The enterprise value is 7.6. So they have essentially $2.6, $2.8 billion in debt. That's kind of a lot. It means they have to spend 4 years of free cash flow to pay off their debt. You've got to remember this when looking at a company, especially one that may be declining. All right. No dividend. It's kind of like profit margin was down last year. I assume they had a write-off here. Let's go pull that up and see if there was some sort of write-off. Maybe they wrote off their Hey Dude investment. So I go to other income and expenses. Boom, right there. $700 million write-off. Just to show you it's not normal. Previous year was 5.5, 1.5, $3 million in profit, 1.7, 22 million. So apart from this 700 million, the biggest one they had was 22. This tells me they wrote something off. Maybe it was the Hey Dude investment. What I'm going to do, guys, I'm going to go quarterly to see which quarter that was taken in. It was 737 million in the June 2025 quarter. So Crocs, 737 million, June 2025, hit to income. Yep, Hey Dude. They took a write-down of $737 million related to Hey Dude. This is a non-cash expense. What that means is it's just a write-off to the value. That is why when we saw the free cash flow, it wasn't a hit, but the net income was. That's exactly why. These are important things to understand and look at, and I know it probably feels overwhelming, but trust me when I say this. It was overwhelming for me at some point. It was overwhelming for Warren Buffett at some point. It was overwhelming for every investor of all time. The question is, who's going to tough through it so that they can understand it better? You're not alone in this, and we are here to simplify this as much as possible. So let's go to the 8 pillars here. We're going to go right here. 8-pillar thriller, okay? Now, their long-term debt here does not include their short-term debt. This is what this metric is, but everything else, even the 5-year PE, is very low. This is interesting. Very, very interesting. Cash flow growth, net income growth. Okay. Interesting stuff. Let's see what analysts have to say. Well, not much optimism here. Analysts basically have the same income for the next 2 years. And look at this revenue. Oh boy. -2, even, -2%. Okay. So analysts believe this is a declining business. Now remember, we sat here and we looked at all of these things, guys. Remember, I want you guys to understand something. These are metrics that I believe, that I use, that I believe are important to look at from a high level. I don't believe in doing nitty-gritty investigation until I've done the high-level stuff, run it in Stock Analyzer. But all these metrics, I want you to understand. So if you're new to the channel, it's really important that we speak the same language. I've created a cheat sheet, absolutely free. Key metrics cheat sheet. What that will do is it's a PDF that'll explain all of these metrics to you, how we calculate them, and why they're important to us. If you want to get that cheat sheet readily available at your fingertips at all times, click the link below. We will send it to you immediately, and it's a great way for you to understand the true metrics of investing. This is exactly why I teach on YouTube. I was sick of everybody saying, oh, that's a great story, pay the price. No, it's about understanding what you're buying and why you're buying it. It's price versus value. This is exactly why understanding these key metrics is a major step in that direction. Let's go now look at what's the right price to pay for Crocs. Let me see if I've done it in the past. I know I have. And let's see what my assumptions were. Ooh, look at me. So the stock's currently at $89. Now, guys, I did a 10-year analysis. Now, look at this. I did negative 3% a year revenue, 0% and 3%. Profit margin. I did 12, 15, and 18. Keep in mind, guys, apart from this profit margin right here, they've only done below 15 in one metric area. That's it. Their free cash flow has been growing, actually, which is incredible. And I still did the same free cash flow margin here. Now, what's the PE and price of free cash flow you would do 10 years from now? Now, I don't know why I had 16, 19, and 22 in here, because if I'm assuming negative revenue growth and not much growth here, I assume it has something to do with my returns on capital. This return on capital is growing. What this means is the business does a good job of being efficient with their money. They can invest it to get good returns, but the business is declining. So what I did here, I remember what I did here now. I put a higher margin of safety in here. I put an 18%. Instead of that, I want to come up with what I think the company is worth. So let's put a PE of 9, 12, and 15. Now, guys, I do this because I always tell people, when you're doing the PE and price of free cash flow, don't worry about where it is right now. The market average is 15 or 16. Go high for good businesses that are growing, down for bad businesses. Now, this is a good business based on the return on capital and high margins, but it's declining. This is what makes it tough. I'm still going to go conservative and say 9, 12, and 15. And then finally, my desired return, I'm just calling it 9% for right now. It's just to get the market return, my intrinsic value. It's not to sit there and say, this is what I'm willing to pay for the company. With that, you got to put a higher desired return in. I hit the analyze button. Again, the stock's at $89 right now. This is why it's interesting. A low price of 73, high price of 208, middle price of 125. If you remember, our community had intrinsic value around 136. So I'm a little bit lower than the community here. Guys, to me, this says, take a deeper look. Now, guys, this video's title was about something about 3 most undervalued stocks or something to that effect. Guys, I don't know what the most undervalued stocks are because I don't know the future. We do this to get your attention, to bring you in and teach you a lesson on how to look at investing. We have no idea what the future holds. All we're saying is probably the most undervalued stocks are not the ones flying high. We want to look at the ones that have been beaten up, that have a bad story that people have turned against. That's what's important to us, and we think Crocs was part of that. Stock number 2, JD.com. Every time I hear JD.com, I think of JD Sports, and it's not JD Sports. JD.com is in China. It's the 3rd largest Chinese e-commerce platform by gross merchandise value. It offers a wide selection of authentic products with speedy, reliable delivery, blah, 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 blah. Now, this company is currently selling for about $30 a share, but more importantly, it's a $43 billion market cap, and here's my issue. Look at this enterprise value. My version is $73 billion. That's $30 billion in debt. And guys, their 5-year average free cash flow is $3.7 billion. Their 1-year free cash flow is about $1 billion. So there might be a little bit of debt on this thing. But again, who knows here? I do like a couple things here. The revenue growth rates, 8% a year for the last 3, 13.5% for the last 5, 23% for the last 10. But guess what? They did $7.5 billion in acquisitions in the last 5 years. So the question becomes, how much of this growth is because of their acquisitions? That takes more detailed investigation. Very low profit margin business, but growing. Their 10-year profit average was 1.87%, 5 years 2.2%, 1 year is about 2.5%. So it's very, very low. These are like grocery store level margins. And look at this gross profit, only 16%. These are the numbers that Amazon was doing just a few years ago. And look at this, 3.4% dividend yield eats up $1 billion of their free cash flow. So in the last year, they weren't able to pay that. They still paid it. They probably had cash lying around and took the cash flow. But in the last 5 years, they can easily afford that. It only eats up less than a third, about 30% of their free cash flow. So right here, I'm looking at this going, okay, what do I think? Well, I think that their PE is very attractive, being single digits. I believe it's China, and that has a very bad rep to it right now. So JD has been beaten down, and the stock is down over 75% from its all-time highs. And a lot of investors have completely written off. Why? A couple things. One, it's down 75%. And when something is down 75%, people out there who just follow stock price hate it. But two, China. It comes from fear, regulations, economy, delisting risk, the whole package. But here's the thing. JD isn't just another e-commerce company. They're one of the biggest and most advanced logistics-driven retailers in the world. They own warehouses. They own delivery. They're investing heavily in automation, AI, infrastructure. This gives them huge control over their customer experience. Guys, if you didn't know what company I was talking about right now, what would you have said? It sounds a lot like Amazon. I'm not saying they're Amazon, but I'm just sitting there saying these are the things that Amazon focuses on. So let's talk about the numbers. So again, shares are down another 13% year to date. But in the third quarter, JD posted nearly 15% revenue growth compared to the same quarter last year. Investors have seen Alibaba shares experience a meteoric rise, and that's having them ask, is JD next? So let's go analyze JD using our tools to determine if it looks interesting today. Now, our community members have it as a buy with a $51 intrinsic value, which is significantly higher than its price of $30 today. Let's go to the 8 pillars. Okay. Obviously, the debt is a lot lower when you factor in the 5-year free cash flow, so it's still a check. They're buying back a couple shares. Bad returns on capital. This is no bueno, guys. I'd expect to see much higher, but we don't know if it's because they're growing so much, because Amazon didn't have great returns on capital as they were growing. 5-year PE, 12.5. 5-year price of free cash flow, also 12.5. Net income growth, cash flow. Let's go see why cash flow is down, because I actually do want to see that. What's the reason? Did they suddenly increase their CapEx? We got to go to annuals here. Oh, so we don't even have the last 12 months. That's why. All right, I'm not worried about that. It's a reporting thing. China doesn't report the same way U.S. companies reports, so I'm not worried about this. They don't have anything in here. Let's just focus on this is still good. And guys, look at this free cash flow. 2.2, 4.3, 2.8, 5, 5.6, 6.3. Growing free cash flow. We like that. Anything else in the... Nope, nothing else here to look at. Analyst estimates. All right. Well, they have $1.47 in profit this year, growing to $5.38 in the next 3 years. 20 times earnings, you're at a $108 company, guys. If they're right, and if you apply 20 earnings PE. Remember, in the long run, stocks are a weighing machine. So yes, there are issues about China, but my question to you is this. Is China becoming better over the last 20 years, and do you project that to happen for the next 20 years? If you don't understand that, you've got to remember the third tenet of our principle-driven investing. If you don't understand it, you don't invest in it. It doesn't mean you're less smart. It just means, hey, I'm going to stay within my circle of competence. I don't get China, I'm out. One of the best investors I know, that's his exact statement to me. I don't feel comfortable with China, I'm out. And I like that. So let's go to our stock analyzer tool. Let's pull up JD.com. If I've done it in the past, which I have. It's been 2 years though. Oh, I didn't do revenue growth, did I? I did not. Not much actually, guys. Even though it was a big jump this year, 5.5, 5.5, 5.5, and a decline here. So not much revenue growth. But it's still China, and they're going through a little lull right now. So let's do 3, 6, and 9% revenue growth. For profit and free cash flow, I'm doing 1.5, 2, and 2.5. Let's do this. Let's do 1.75, 2.25, and 2.75. And we're going to do the same thing. But their free cash flow tends to... I'm still going to do the same thing for free cash flow. Now, guys, keep in mind, my middle assumptions here are lower than their profit margin they did last year. And it is increasing. So I could be conservative here. Now, what is the PE and price of free cash flow for this company for the next 10 years? 10 years from now, I mean. Well, guys, look at this. We talked about returns on capital being low, but it's getting better. The last 10-year average was 2.5. Last 5 years, 5.5. Last 1 year is 9%. So again, what do we put in here? It's China, but I want to be, I'll put the China risk in my desired return. I'm actually going to give this 15, 17.5, and 20. And again, my 9%, no margin of safety return. So now I hit the analyze button. The stock's currently at 29. This is why it's interesting. Low price of 33, high price of 100, middle price of 59. Very close to our community members' also intrinsic price, which gives us a 20% return if all of my middle assumptions occur. Now that's a big if, but the point is, if you had 100 companies in your portfolio that had these assumptions, you're probably going to do pretty well. How well, I don't know, but you're probably going to do pretty stinking good. Stock number 3, Oracle. Now, guys, this is an AI name that should catch your attention. As many of you know, Oracle is one of the world's largest enterprise software and technology companies. Historically, it has been known for its database products and enterprise software. But over recent years, the company has transformed itself into a cloud and infrastructure provider with a focus on AI-ready services that help enterprises run large-scale workloads. In its most recent quarter, Oracle reported strong revenue growth of 14% year over year. Guys, that's huge for a company this large. Cloud revenue alone was 33%, and cloud infrastructure was up 66% as businesses increasingly adopt cloud and AI platforms. Now, here's where it gets even more interesting. Oracle itself is up 15% year to date, but it's also down over 30% from its September highs. I don't know if you remember when the founder, Larry Ellison, briefly claimed the world's highest net worth. I think he gained $100 billion in one day. So the question becomes, is this fall creating an opportunity, or is it just Oracle's valuation coming back to reality? The company is currently a $574 billion market cap with $730 billion enterprise value, $150 billion in debt. Now, if you look at their cash flow, it is negative in the last year. I'm willing to bet why. It's probably because of capital expenditures for AI. So let's go verify that by going to the cash flow statement. We go to their capital expenditures and look at the jump over the last years, guys. Right during COVID, they spent $1.6 billion in capital expenditures. The last 12 months, they spent $35 billion. Now, it hits the cash flow statement, but it's investing in the business for the future. The question is, are they going to be right? These are the risks you take when you invest in companies. You got to hope that their capital allocation is done well. But this is not something to sit there and go, oh my God, cash flow fell because cash from operations were bad. No, it keeps getting better. Their cash from operations keeps growing. That's something to keep in mind as you're looking at this company. Let's go back to the metrics. They pay about $5.5 billion in dividends, which is 1% dividend yield, nothing major. Profit margin last year was 25% versus the last 10 years and 5-year average of 22%. Gross profit, pretty close to it's like Microsoft level, close to 70%. Returns on capital are down recently, but in the last 5 years, 16%. I mean, guys, the only thing that stinks is you can't sit there and look at free cash flow. It's absolutely useless. They brought in $61 billion in revenue, guys. $15 billion in net income. I mean, this is a company that has a lot of potential, and they're investing a lot. Our community members have an intrinsic value of 142 with an average rating of a sell right now. Yeah, okay. Let's go to the 8 pillars here. Ooh, a lot of red. Remember, red doesn't mean don't buy. Again, the example I give, would you pay $1? Not $1 per share. Would you pay $1 for Oracle right now? Of course you would. Even with all this red, you'd still pay that. Would you pay $800 trillion? Of course you wouldn't. Even if this was all green, you wouldn't do that. It's about telling a story. Revenue's up. Net income's up. Obviously, cash flow is down. I'm not worried about that. 5-year PE and 5-year price of free cash flow are high. They've issued shares. Why are they doing that? Because the stock is expensive? These are the things you have to sit there and consider. Let's see what analysts think about the company. Wow. Earnings per share over tripling in the next 5 years to $21 per share. If you put a 20 PE to this, that's a $420 stock price. $420 stock price. Remember where the stock is right now, $196. That's a lot of growth. That's over double if the analysts are correct. Revenue growth, 17%, 25%, 50%, 45%, 23%. What the F? Guys, this is too much growth for a company this large. I just have a hard time believing they're going to be right on this. That's insane. Guys, I have felt that panic in my gut as well. When stocks fall, fear takes over. You start thinking, do I sell before it gets worse? I've been there. I've made those emotional decisions and I paid heavily for them. But patience and planning are what separates principle-driven investors from degenerate gamblers. Once you understand value and how to determine it, your perspective completely transforms. Price drops become golden opportunities, not disasters. That's what we teach at Everything Money. How to think long-term and stay calm when other investors start losing their minds and they dig holes that kneecap their financial future. Get access to the tools and the knowledge that protect your portfolio and your future from those emotional decisions that will destroy wealth. Start your 7-day trial right now. Guys, and I want you to look at this article right now, how Oracle became the poster child for AI bubble fears. I don't know. This is seeming a lot of stuff going on here. The question is, can we pay a reasonable price? The issue I have is Stock Analyzer. Let's just pull this thing up right now because I'm going to make some changes to what I'm sure I've done as of late. 10-year analysis, 8, 11, and 14%. Here's what I'm going to do. I'm going to do 6, 13, and 20%. Like 20% revenue growth for the next 10 years is insane. What would that make it? 1.2 to the power of 10. That'd make them 6. I mean, it's possible. I'm going to do that. Profit margin, 20, 22, and 24. PE of 17, 20, and 23. And my 9% return. Guys, remember, I went really high over here. Even this is high, 13% a year. I'm a little apprehensive about this. Profit margins would probably be higher, but the stock's currently around $200. I hit the analyze button. This is why I'm apprehensive. 86 on the low side, 376 on the high, 180 in the middle. So that 180 is still assuming 13% revenue growth for the next 10 years, which is still a lot of revenue growth. Now, guys, earlier this year, I've picked 7 stocks to start that would go head to head with the Magnificent 7. So click the video on your screen to see which 7 stocks I picked and how they stack up to the real Magnificent 7. The results might surprise you. Thank you for your time.